of course. Joel is one of the greatest, most successful stock pickers of all time. He is truly a shining example of an active manager who has been able to beat the street. If you were to look up alpha in the dictionary, I would argue there should be a picture of Joel. He is a unique, one-of-a-kind investor, so there is no recipe for replicating his success. That said, Joel clearly embodies the qualities and characteristics that I believe are critical to being a great investor. He is patient, open-minded, and flexible. He also has the ability to ignore the worries of the world long enough to allow his investments to succeed, and he has a willingness to do independent research and an equal willingness to admit when he is wrong and exit. He is persistent but not stubborn. While good investors have some of these qualities, great investors like Joel have all of them. Another quality that truly separates Joel from the rest of the professional investing pack is his ability to find value where no one else, or at least very few, might be looking. In his book, Joel talks about water utility stocks. Water stocks are boring, and when you add in strange names like Dor Comrie, Welsh water, Severn Trent, and Northumbrian water, it is almost a given that very few people are looking at them, certainly not to the degree of analysts covering companies like Google or Apple. Those who do look usually do not have the patience and commitment to doing the deep fundamental research needed to understand the stories and find opportunities. I remember talking with Joel about these water utilities, and the fundamental story was really compelling. Who else but Joel would look at these? Joel also has shown a consistent ability to find long-term growth stocks before they experience their big run-ups. After all, it is the ones you miss on the way up that hurt the most. In this book, Joel highlights a few of the companies he found early in their growth cycle that ended up being big contributors to past performance of the Fidelity Low-Priced Stock Fund. Names such as Ross Stores, AutoZone, Monster Beverage, Ansys, and numerous others. The tendency of most investors is to cash out after a stock moves up 10 or 15% and move on to something else. But just because a stock goes up 10 or 15% doesn't mean there isn't room for significantly more growth. A successful investor is one who holds on for the long term and continues to monitor the fundamental story. And if it remains in place, you stay, and if not, you move on. It is that and his other skills that made Joel such an incredibly successful investor over his career. In Big Money Thinks Small, Joel draws on all his experience as a seasoned active equity mutual fund manager to illustrate how certain investment theories can succeed and fail. While he has proven a keen ability to succeed over his career, Joel, like all investors, is not infallible. Stock picking is hard work, and over nearly 3 decades, even the best investors like Joel are going to make mistakes. It is what you do over your complete body of work that matters. In this book, Joel does an exceptional job of examining some of his major sources of investment regrets and suggests ways readers can potentially avoid the same mistakes. Joel argues that while you cannot learn to be a great investor, you can learn to shy away from mistakes and be a successful one. Persuasive stock promoters and others can lead the average investor into overconfidence and rash decisions. Joel writes that acting cautiously, avoiding mistakes, and being patient are far more likely to pay off than a few bold investments. In his book, Joel introduces 5 key principles for avoiding investment mishaps. Depending on whether your glass is half full or half empty, these principles can be seen as things to avoid or things to do. For example, 1. Do not invest emotionally, using gut feel. Do invest patiently and rationally. 2. Do not invest in things you don't understand, using knowledge you don't have. Do invest in what you know. 3. Do not invest with crooks or idiots. Do invest with capable, honest managers. 4. Do not invest in faddish or fast-changing, commoditized businesses with a lot of debt. Do invest in resilient businesses with a niche and strong balance sheet. 5.